Hi, this is Roger Smith of the True Blue Lounge, and today we're going to Ask an Advisor. This is a new series I'm trying to promote where we're going to talk to people in industry. Today we're going to talk about insurance, tomorrow it may be car buying or real estate. Please like, subscribe, and send to a friend. And without further ado, meet my co-host, Steve McDonald, and our advisor. In this case, it's Terrence Fenton on insurance.
Good evening. And just wanted to quickly introduce myself. As Roger mentioned, my name is Steve McDonald. And just a quick information about me. I have been in the financial services industry for, so well over 30 years going on, well over 20 years going on, 30 years for sure. I hold a few different professional designations. I am a certified financial planner, CFP. I'm a chartered life underwriter, CLU. I'm a fellow of the Life Management Institute, FLMI. I'm a financial management advisor, FMA, and also an EPC, Elder Planner Counselor. I've been working with, I've worked in the insurance industry and I've worked in the investment industry. And we thought it would be necessary to bring this to our Blue Blood group just to provide additional information in the financial sector and to share our knowledge on how we can create financial security. We can help you to achieve financial security and also generational wealth. Now, and also provide for certain financial risks that may come about during our lifetime. Without further, our featured guest for today is Terrence, and without further ado, I'll have Terrence introduce himself.
Yes, so of course I'm Terrence Fenton, formerly of Mannings myself. And how do you follow that intro with all those designations, right? I've been an insurance agent for, I think, around about 5 years. So I started in the insurance industry. I'll take a little step back before that. So coming in the industry, I had, you grew up watching these movies and learning about different ways how people create wealth. So I was like, I'm in New York. What better place, the financial capital of the world, right? So got here, had every intention of being a full service financial advisor. Tried in the early stages to go into one of the most prestigious companies, right? Goldman Sachs, but didn't have the opportunity. So I learned if you go through insurance, then you can go all the way up. Started with insurance. So my background essentially is with insurance. Then from there, I acquired all the different licenses. So started from the 6 and the 63, and then I did the 7, and then I did the 65, right? So fully licensed when it comes to insurance, fully licensed when it comes to the investments. So overall, now, with that background with risk management, I'm now working with my clients to make sure that not only are they covered from a risk management standpoint, but growing that wealth, essentially making sure that their money works for them.
Thank you. And for those of us who may not are not from the US, you mentioned some 67 so forth, or 69, not too sure which one, but anyway. Sorry, I do apologize. In terms of what was those figures? Was it that you're licensed to do to sell a specific type of products?
Yeah. So the of course with insurance, you're licensed in the specific states that you hold said license. So I got my license in New York. Of course, New York is my home state, so that allows for me to be using my home state, New York. I can be licensed in several different states, right?
Okay.
When it comes to the investments, it's a little bit more different. It's not state regulated, it's federally regulated. So
Okay.
no, those license.
So federally
when I
mean that you can sell to anyone across the country? Is that what federally mean?
yeah.
Okay. Okay.
No, the Series 6 is what I started from. I was in an insurance company. So the Series 6 allows you to sell variable insurance products. You're talking about life insurance products that have, your cash value invested in the market. And then you're talking about the variable annuity products. Now,
Okay.
annuities,
So,
of course,
just
they have
remember
the
that
worst.
all of us might not be familiar with the jargons, variable, and all of that. So if you can just break it down to so that we can understand it. What do you mean by
Definitely.
variable and
Definitely,
so forth?
definitely. So life insurance in general, of course, is for risk management. When you're talking about permanent life insurance products, typically you get a policy today and it lasts for the rest of your life.
Mhm.
Those products typically will have cash accumulating in it. So think your car insurance. If something happens, they're gonna pay a claim. If you never use it, there's nothing to gain. So if you ever canceled it, there's no refund you're ever gonna get.
Right.
So with the life insurance piece, typically when it comes to permanent life insurance, whether it's the traditional whole life, universal life, variable universal life, which I'll talk about the variable in a second, those typically have a cash value accumulation in there.
Okay.
Now with
So you pay
variable,
money, you get back something.
right? When it
Okay.
comes to the variable, what I'm really referring to are those insurance products that have your money invested in the market. And I'm talking
Okay.
about the market, I'm talking about the S&P 500 or different
Stock market.
mutual funds that you can invest in.
Okay. Okay. I just when you said risk management, what exactly? How you describe risk management? Are you talking like the dying too soon or something like that? Explain risk management to me and how, like the average person,
Yeah,
what would that?
of course. So when I refer to risk management, of course, the basic risk management when it comes to life insurance is pretty much dying too soon, right? For my younger audience, right, you have all these goals. I remember, growing up, I have every intention of buying, my mother a house, right? I have all these grandiose goals that I want to do for myself, for my family, but all those take time, right? Now, one of the things that we just don't know how much we have is time. When it comes to, managing that risk, all right, I need 20 years, 30 years, whatever the case may be, to create this wealth, to do these great things, but I just don't know if I'm going to have those 30 years. Getting the
Especially if you have
life
a young
insurance,
family, I would presume, right?
right? Having that
Okay.
life insurance from that standpoint, for that younger person, having that life insurance in the beginning allows that, well, if I run out of time, if I pass away early, right,
Right.
that death benefit is going to be there. Now, there are other risks that life insurance can mitigate,
Hmm.
right? So it's not just the dying too soon,
Right.
right? There are tax mitigations that you can use life insurance to deal with, because of course the death benefit in life insurance is always going to be tax free. There's and it's not necessarily only the death benefit, the cash value that's accumulating in there. You have the access to said cash value tax free as well. Of course, in our environment right now,
So
this is my
pause one
opinion.
quick minute. So you're saying
Yes.
that I can buy a life insurance plan and then it start to build up this cash value and I can get it while I'm alive, or are you saying that I can get it when I pass away? Or my family can get it more so when I pass away as part of my policy, meaning that if I bought 500,000 life insurance death benefit coverage, and then I have 100,000 cash value, my family can get 600,000, or would it be 500,000? Or I can get the amount when I'm alive, like to start a business.
So very important. So when it comes to that cash value, leaving behind both the cash value and the death benefit is very possible. It's very important to make sure that the structure of the policy facilitates that. So you can have a life insurance policy where the cash value is building up in there, where you can access it while you're alive.
Mm.
But you can also have that policy structured in such a way where when you pass away, your family is getting both that cash value accumulation plus that death benefit. So it's
Oh,
very
wow.
important to make sure that it's structured to facilitate your personal goals.
But I wouldn't know that as a consumer. Is it that you would structure it that way, or how does that structuring come about?
Yes, so so fundamentally, both different structures affects the cost, right?
Mm.
When the cash value is accumulating in the policy and there's that level death benefit, it's typically less expensive.
And when you say level debt benefit, you mean the 500,000 that I bought?
So if you bought
Okay.
a $500,000 policy
Uh-huh.
and it's staying level for the duration of your life, let's say you're living to age 120, and if you live to age 120, you need to tell me the secret.
Right.
But if it never increases, right, and that cash value is accumulating on the inside of that policy, that usually is less expensive.
Okay.
Now, there is the other option where the cash value is accumulating, but your $500,000, if you had 100,000 in there, the $500,000 then grew to pretty much 600,000 because it's paying out both your cash value plus your death benefit. That typically is a little bit more expensive. And I could go
So
into the
you're getting
weeds in
more
terms of
benefit,
why
I
that is.
presume, right? You're getting more benefit. Or your
Yes.
beneficiary getting more benefit. Okay.
Yes.
Okay. So you mentioned something about estate taxes too as one of the risk. So is it there that you would use that type of policies? Let's say your value is increasing, you would have something like that? Or how
So
would you
for
determine?
so for estate taxes, and this is more oftentimes with the more wealthy, folks, right? You have a business, you have real estate portfolios, you have several assets. It doesn't even matter what kind of assets you have. The death benefit from the life insurance policy can be used to ultimately cover the cost of those estate taxes. So, for instance, especially if you have illiquid assets, real estate, business, when it gets to, for instance, in New York, I believe right now the estate taxes has been risen to 7.5 million. So if you have business real estate and it's cumulatively above the value of New York's estate taxes, when you pass away, your assets go through probate, goes to court. The judge then, of course, determines how it's going to be distributed. But then the government wants their cut, for lack of a better term. No, these are illiquid assets. Your family, whosoever are the beneficiaries, they have to figure out where that money is going to come from. Now, you work so hard to create this business, to buy all these real estate, the different kind of real estate, depending on what your
Right.
portfolio is.
The
You
different
work so hard
assets.
to create this. And then more than likely, if they don't have that liquid funds, they're probably going to have to sell. They're going to have to sell. They're probably going to have to break up that business. They're probably going to have
And it
to
may
sell
not be the
properties in
right
order.
time to sell either.
Exactly. So ideally, having the life insurance policy, and of course, structure is important with that as well, because if the life insurance is owned by you, then it's also going to be included in your estate. You don't want to have that. So you
Right.
want to have the policy owned by a trust. More ideally owned by a trust. It doesn't necessarily have to be owned by a trust, but if it's owned by a trust, then essentially it's taken away from your estate and it's paid out tax-free, to which they can then use to pay those estate taxes, and none of your other illiquid assets would have been touched.
That's interesting. I've heard something where and similar to that, where the taxes were like, let's say 300,000, and the persons they wanted a debt benefit of that 300,000, and that cost them 100,000 to get that debt benefit. So they had a savings of 200,000. So those are the things that you're talking about, and that you can help clients to establish.
Yes.
Okay, nice. So that's good to know. You mentioned state for life insurance. So which states do you cover or can you sell life insurance for? You said you can do investment federally. Like which states would you cover?
So right now, I am licensed in New York. I'm licensed in New Jersey, and I'm licensed in North Carolina for life insurance in particular. No,
Okay.
I had license in other states like Georgia, South Carolina. Because I'm physically located in New York, I've not been practicing as much out of state. But I mean, if clients want to work with me in any one of the 50 states, I can work with them. It's
Okay.
pretty much just paperwork.
Okay. Okay, understood. And the insurance principle would be more or less the same whichever state you're in, right? Okay,
Yeah.
well, good to know. Good to know. So we covered in terms of risk of dying too soon. So I would guess too, you mentioned younger people. So if I have a young family, and especially with a daughter who would be, let's say, just born, right? And I want to say do some provision for that family. I'm earning, let's say, 100,000 for easy calculation. You would probably put like 20 years worth of income. Is that how you would look at it? And do you use this also to cover mortgages?
So, all right. So we'll touch on the child first. So there are a few different ways that I can do it. Typically, I want to know a little bit more about what their goals are for that child.
Mhm.
So, do you have any intention of, paying for your kids' college, right? No, that's going to tell me that they want to make sure that they're going to take care of that child for more than 20
Mhm.
years, right? Typically, the child would start college maybe around about 18, 19 years old, and they're probably going to be there for, 4 or 5 years. So you're looking at maybe 23, 24. No,
24 years of income if the
yes,
person should pass away at the time you're speaking to them.
yes.
Wow. Okay.
So, having, I look at it, I'm like, listen, you're making $100,000 currently, right? Now, God forbid you didn't wake up this morning. You have a 1-year-old, a 0-year-old, doesn't matter.
Right.
If you didn't wake up this morning, right? That's 100,000 of income that's gone instantly. No,
For the next 24 years.
no, $100,000 in income missing for the next 24 years where you're no longer around, right? So when we look at that number, right, the question remains as to whether or not they think they would be doing any justice in terms of making sure that they're not putting something in place to make sure that they're mitigating that risk. We
Mhm.
spoke about it before, right? The one thing that we just don't know how much we have of is time.
Time. Okay. Okay. And speaking of time, the same thing too, I guess. So a lot of times too, I hear people getting insurance from their banks to cover their mortgage. But let's say I wanted to do something. I said, you know what? I want to shop around. Oh, by the way, so the mortgage side of it, and two, is it like your practice is the brokerage, or do you get quotes from a number of different companies, or you're just associated with one company?
So my primary contract is with one company. However, through that existing relationship, I can write business with several different insurance companies,
Okay.
right? So
So
I have
you,
the capacity to be able to write with external companies. No,
okay.
I typically write with just one, and I
Mhm.
do that just because I'm yet to find another company that ultimately gives the amount of value. And I don't want to list the company, give some free advertisement, but
Right.
but 30-year, typically a mortgage is 30 years, right?
Right.
There are not many companies that offer 30-year level
Coverage.
the premium, right?
Okay.
That they do. And even with offering a 30-year mortgage, I've worked now with 2 different insurance companies, and first one, they only had, the maximum was a 20-year, right?
Okay.
No, this one, of course, offers 30 years, and even at a 30-year level premium, it's still less expensive than my former company's 20 years. So
Okay.
I am yet to find the value that company offers. And additionally, especially since again, the least expensive kind of insurance is going to be term insurance. And if you're doing a 30-year mortgage and you just want to protect yourself for that risk entirely, like if something happens to you, you want to make sure the mortgage is going to be paid off. A 30-year term life insurance works. But the thing is, having the option to convert even a part of that term insurance to a permanent one, I think couldn't be more important, because the reality is 30
Explain
years
that
down
for
the
me.
line.
Explain
Yeah.
why you say that.
So having a term insurance, remember, we're trying to make sure that we are mitigating the risk. No, let's say you're young, let's say 40. You're 40 years old. You just bought your first piece of real estate. It's $500,000. You took out a $400,000 mortgage, right? Now, again, we talked about the risk of time. We just don't know how much time we have left.
Mhm.
And you have your family, young family, maybe a 5-year-old, doesn't matter what the age is, but you want to make sure that if something happens to you, that mortgage will be paid off in full.
Mhm.
So you get, let's say, a $400,000 life insurance policy for the duration of the mortgage, 30 years,
Right.
right? And now you're getting close to the end of the term of that policy.
So
That
you're
was the only
now in the
policy.
28th year or the 25th year.
28, 20, 25, typically, the
Right.
conversion privilege for most companies typically will end either at the end of the term or at age 60, 65, whichever
Right.
comes sooner,
When you say
ultimately.
conversion privilege, I guess that's where I want you to explain what you mean by that.
Good. So I was getting to that. So you're getting to the end of the term early in my stages, right? I was young. I didn't have a need more than just to cover this debt.
The
Now
mortgage.
I'm older. I'm
Right.
50. I'm 60. I'm 65, whatever the case may be.
You have
My
diabetes.
needs have changed.
You have diabetes and you probably have cholesterol like myself, but anyway, go on. And probably blood pressure. Life.
So of course, some illnesses could happen, but even then, your needs have changed. No, you ultimately need something permanent,
Mm-hmm.
right? You want to cover your final expenses. You want to cover estate taxes, whatever the case may be. These are all permanent needs because you just don't know how much longer you have. You could live a long life, right?
Right.
No, having a permanent insurance becomes even more important at that time. The conversion option pretty much just means you can convert either all off or a part of your existing term insurance,
Okay.
which term insurance is permanent. It's temporary. It's
To
just
term mean
for
that
one
it's
duration
going
to another.
end at some point. Like I'm leasing or renting somewhere, and permanent mean that I own the building, so to speak.
Right. So
Okay.
it's like
And you
you're
said,
renting with the option to own.
oh, renting it down. Okay, cool.
But
So
it's very important to know that not every life insurance policy offers that.
oh, wow. Okay. I guess that's what they call the fine print.
Yeah.
And that's why we need a good broker to be able to point out and to assess and to get competitive prices and so forth. But one quick thing, so I mentioned earlier that I have a few ailments, and I probably had a heart attack, or I have a excessive drinking problem, or I'm from close from Negril side, so yeah, and but how would that my medical condition, current medical condition, affect the conversion? Because I've always heard that to get life insurance you have to do a medical, or you have to pass the medical.
Yeah, good question. So typically, when you have that term policy, you have locked in your health from the time you got it. So if you got it when you were 30, 35, 40, doesn't matter. whatever your health was at that time, you're contractually locking that health in. So it doesn't matter. And I can say this. I had a mentor a few years ago who, this was someone who played football. That's American football all through high school, all through college, right? In his 50s, very, very physical guy, very exercise all the time. And he actually was doing like a walkathon or something, and he had a heart attack in his 50s. I think he was about 55. So in his 50s, he had a heart attack. He thought he was going to die. He was what he told me. And then he went into the hospital and they put a few stents in his heart. No, here's the thing. Even though those stents has extended the amount of time he has on this earth, right? He's not going to have heart issues as a result of those stents. He will never qualify for life insurance ever again.
Wow.
No, if he had term insurance prior to that, it doesn't matter that he is no longer able to get insurance. That contract ultimately locked in his health from the time he got the policy originally, and he now has the option to convert the whole thing using that good health that he had before. The only thing is that it's going to now cost a little bit more fundamentally because they're charging you based on your current age. So they're locking in your health, but they're charging you based on your current age at the time of conversion.
Okay. No, that's good though, because you sure said there isn't anything in the fine print that would make them not pay out, because we know that when it comes to time for pay out, it's always an issue.
Listen, so there are only two instances. There's nothing in the fine print that would cause them not to pay out with that. But there's only two instances that, for at least for the companies that I work with, right, that they would never pay out a claim. One, and these are the two instances are only in the first 2 years, and one instance where it wouldn't be regardless of the time when it happens. So one, if you commit a suicide within the first 2 years of the contract, so you got the life insurance policy with the whole intention of to go kill yourself, they're not going to pay out. They're going to pay back only the amount that you paid, so your premiums, right? And then the second instance is if you were killed as a result of you committing a crime. So you decided that you were going to go rob a bank, and then they shot you and killed you robbing the bank. They're not going to pay out. Again, in that instance, they're only going to pay out your premiums back plus any interest you would have accrued. Other than that, there is no other fine print. And these are for the companies that I write with.
So suppose I give them fraudulent information up front, and then did not tell them that I had that heart condition, and and they eventually find out.
Good question. So that typically, that's one of the things that I forgot to mention. But that only is if that happens. If so, you gave them the fraudulent information. You lied. You said, you know what, I don't smoke, or you told them you didn't have some illness, and you passed away in the first 2 years. In the first 2 years, they won't pay out. If it goes beyond the first 2 years, you're fine.
Okay, that's interesting. That's interesting in terms from that
you've
regard.
passed that contestability period, which typically is in the first 2 years.
Okay, so that's what they refer to as the incontestability period. Okay, I get you. All right. So let's moving on from life insurance a quick bit. And going on to critical illness, disability insurance, long-term care. Are those things that you also offer through your practice?
Yeah. So, of course, it's something that I've been very passionate about fundamentally because I have a grandmother who is currently, I think it's Alzheimer's she has, right? So she has round the clock care.
What you said you're passionate about, you didn't add which one?
Well, sorry, long-term care.
Okay.
Long-term care fundamentally, I mean, with long-term care, it's pretty much you're not able to do at least 2 of the 6 activities of daily living anymore. So that's something that I'm personally connected to because I've seen the effects of what long-term care does.
Okay.
Right. No.
And the 6 activities of daily living you're referring to is what? Bathing, eating, clothing, moving, and something like that.
Yep.
And if you can't do 2, you're able to qualify for what?
So typically, at least in so typically in the United States, if you need care, you would need to either pay for it yourself, or you can have
Right.
the government foot the bill.
Right.
Now, for you to have the government foot the bill, that would be through Medicaid,
Okay.
not Medicare. I don't want people to mix that up.
Okay.
Medicare, Medicaid, two different things. No, Medicare does not, even though when you get to 65, you get your health insurance through Medicare.
Right.
Medicare does not cover long-term care.
Right.
So you'd have to qualify for the government to foot the bill. You'd have to qualify for Medicaid, which means you can't afford to. You do not have the money, right? So if you can't do 2 of the 6 activities of daily living, you can qualify for long-term care and have the government foot the bill, but you have to prove that you financially are not able to afford it.
Okay.
Now, again, you can pay for it yourself. You can have the government foot the bill, or the next option, which is through insurance.
So when you say government foot the bill, is there a limit? Like suppose, and I don't know what the cost of these places are over in the US. I know over here it can easily run you anywhere from 5,000 a month to even 10,000, depending on the facility.
Yeah, so
So
I'm yet to meet the person that actually wants to go into a facility. Most people want to stay in their own home, right?
right,
And that gets a little expensive, right? Because if you're in your own home, even before you start to have someone come and take care of you, and quite often, I know when I was growing up, the whole idea was, you take care of your kids and then they come to take care of you, right?
right,
The problem is that idea ultimately kind of means that child that's going to take care of me doesn't have any family that they need to take care of, right?
right.
So they don't have kids that
That's
they
the
need to
sandwich
go and
generation
work.
where you're talking about now, where you have your own family plus you have your parents' family.
Right.
Okay,
So you got to, those folks who have their own family, they have a spouse and they have kids.
right,
They need to provide for a living. So they need to go to work. So that idea where that parent is like, well, my kids are going to take care of me. The question that I'd ask is, well, did they know that? Because they got to go to work. And in the
yeah,
day, in the day when you need someone to take you around to, make sure that you can get a shower, make sure that you can get something to eat. I mean, how would they earn a living if they physically can't go out? They have to be there taking care of you.
right,
Now, there are ways that you can do that if you're paying through insurance, right? Like you can actually pay them to take care of you, but that's going somewhere entirely different altogether.
mhm,
Now, additionally, one of the risks involved, especially if so you can qualify for the government to pay for your care in your home. So
mhm.
they pay for a nurse to come take care of you. And the cost ultimately usually around about $60,000 a year. So the same 5,000 you were talking about per month, it's
Mhm.
usually around about $5,000 per month.
And the government pay all of that?
And the government will foot they will foot the bill. The
Okay,
problem typically is, well, you've worked hard, typically the American dream for most people, not for everybody, is
right,
to own your own home.
right,
So even if you don't have the money, right? So you don't have the money, the government, you qualify for Medicaid because you don't have the actual liquid money to pay for your own
right,
care. So
right,
the government will come in. One of the challenges that ultimately can happen is they can put a lien on that house that you work so hard to attain, that you have every intention of leaving for your daughter or your son or your grandkids. They can put a lien on that house after they've finished taking care of you and recoup every dollar that is spent on you from that house. So that house
wow,
would not be there for you to leave for your kids or your grandkids. They
wow,
absolutely can do that after you pass away.
wow. That's interesting. So in terms of you mentioned the insurance. So this one is a bit so long-term care insurance. This one seemed to be a bit different than the life insurance that pays out while you're dead. It pays out while you're alive.
Yep.
So is it that you get like a monthly amount or an annual amount, or you get one lump sum? How does that work?
So typically, you can get a monthly, and the one that I like for my clients primarily, and I mean, you have traditional long-term care insurance separate, just like you have
Mhm.
health insurance and every other kind of insurance. You
So
have
they have different
long-term care.
variation. So you have
Yes,
choices.
yes, you have long-term care insurance that ultimately will, you know, give you that payout, give you a check that you ultimately can use to pay for your care.
Mhm.
That's the traditional long-term care insurance. There's nothing wrong with it.
So give you a check how often?
Monthly.
Okay.
No, or typically it's monthly. I
Right.
don't necessarily love it for my clients because it's a use it or lose it. If you never need it, it's good that you had it, but if you never used it, then it's gone, right? I don't necessarily love it for my clients. So typically, what I use for my clients is I will get them a life insurance policy with a long term care rider on there. Now,
Okay.
that to me kind of satisfies all the goals. Now, if you pass away, you're leaving behind a legacy through the death benefit.
Mm.
Now, if you're alive and you're healthy and you need access to your money, you have a cash value that's accumulating. If you
Okay.
ultimately need care, you can accelerate the death benefit, not the cash value. So if you had $10,000 in cash value in your policy and you are not able to do two of the six activities a day living, the death
Right.
benefit was like a $500,000. You could start to spend down the death benefit, that $500,000. You could start to spend that down to fund your own care.
Okay. So
Now
it's
the
like a
company,
hybrid life insurance now.
yeah. Now,
Okay.
the companies
Interesting.
that I use offer this flexibility, and this is where I said that you could ultimately pay your child to take care of you. The
Okay.
companies that I like to use are very flexible. They don't care who you're spending the money with. They don't care what you're using the money to do. They just want to know that you qualified based on the standpoint of you're not able to do two of the six activities of
Mhm.
daily living. So they'll send you that check monthly. You could pay your kids, you could pay your friend next door. If you want to jump on the plane and fly to Jamaica to have a vacation on the beach, you could do that. They're going to send you that check just because you qualify from the standpoint of you're not able to do two of the six
Right.
activities of daily living.
Okay. Okay, I get you. I get you. I get you. But let's keep it at that. They really need the utilize the service from that standpoint. The other one I really want to touch on really quick too. You also do critical illness and you do disability insurance for people who are self-employed, I would guess.
So I don't incorporate that in my practice. It's something that I'm licensed to do. I don't
Okay.
do it so much. Um, just because I have just not met too many
Your
um
clientele.
yeah,
Okay.
and disability insurance tend to be a very stringent as to who they will issue it to. They pretty much prefer like corporate workers, the
Yeah.
attorneys, the doctors, the accountants. They prefer to because they're not taking on too much risk, right? So those folks that ultimately would work, let's say in construction, usually it's a little bit more difficult for them to qualify for disability insurance, at least with the companies that I've worked with in the past. And because
Mhm.
of that, and those are people that ultimately would need it most, right? Because
Right. Right.
they're more hands-on in the work that they're doing. They're taking on more risks, so it's more likely that they could get an injury that could have them out of the workplace, and I can't
Right.
get the insurance for them. So I'm like, you know what? I'll leave that out of my practice.
Understood, understood. But like critical illness is something that you would incorporate. Do you offer like critical illness?
The only critical illness insurance that I do would be the long-term care.
Okay,
Not so much,
understood.
not so much outside
Understood.
of that.
Not so much in terms of the other critical illness. And just for the sake of the viewers, critical illness usually is an insurance that have a payout. Again, it pays out when you're alive, and if you have they have covered conditions Sometime it may be, depending on the policy, could be up to 25, 26 different type of critical illnesses. A critical illness would be like a heart attack, a stroke, something that is, as the name suggests, critical in nature that can cause death. So diabetes would not be considered a critical illness. And then you have to survive by, I think it's 90 days in most areas. And once you survive by 90 days, you will get the payout of the amount. So that is how that usually work. Let's jump real quick into the investment section. Talk to us about that in terms of what you offer in terms of investments and how that works.
Yeah, so in terms of investments, of course, I mean, all the investments that every single platform offers, I have that available at my disposal, right? Fundamentally, I focus more, not necessarily just with the investment, it's more the strategy as to, the value that I bring.
Right. But just stick a pin. When you say all the investments, are you talking about stocks, mutual funds, ETFs, or
not so
what?
much, but
Gold,
indirectly. So
Bitcoin?
indirectly, yes, but not necessarily what I was referring to. So
Okay.
on my platform, I have the BlackRock, the American funds, the Goldman Sachs, the JP Morgan. It's interesting that I don't work specifically for these companies, but on the platform, depending on my clients' goals. So what I look at when I'm having conversations with my clients is I want to understand exactly what their risk tolerance is, what their goals are, what kind of returns are they looking for, right? If you want to have much higher returns, then we have to have an understanding that may require, and I say may require, you taking on more risk, right? And I stress the may because
when you say more risk, are you talking about volatility, or are you losing your money, or what? Tell me.
Referring to volatility.
Okay.
So when you're in equities, stocks, right? I know everybody. Let me not say everybody. Most people, they want to get that home run, right? They just buy that stock and see the portfolio.
They won't go up. They won't make money.
They want to see the return right away.
Right.
Now, if we look at historically as to what the S&P 500 have done over the years, right? From inception, the market has grown, I believe, the last time I looked at it, almost, if not about 7,000%. However, when you look
over what time frame? Sorry.
From inception.
Okay.
Now, when you look at the entire duration of the market from that time until today, you see the variation where, yes, over that time frame, it's pretty much just looking like it's going up. But then when you zoom in, there are specific years when they were down, right? So with me, we have to have an understanding as to what your goals are, what in terms of not just the kind of returns, but your timeline. Because you may tell me that you want to get 20% return year over year, and you want to have access to your money in 2 years. That may not necessarily go hand in hand, because you go all in equities, you can have a down market next year, and then when you're looking at taking a withdrawal, you're taking a withdrawal when the market is down. It's not necessarily, that doesn't correlate, right? So for me, we can work on the returns. The investments are there. Whatever investments my clients want to have, they want to go in Bitcoin, I'm not going to buy them Bitcoin, but they are ETFs or mutual funds that have ETFs in there, so they can get the Bitcoin,
have Bitcoin
exposure.
In there. Okay.
They can get the Bitcoin exposure without necessarily having to own Bitcoin. So whatever they are looking for, I can offer it, but we have to have an understanding as to, what amount of risk that we want to take, what's the timeline, what are the goals that my clients want, and that's how I work with them. We're doing the coaching from the standpoint of, well, you'll have the clients, if they were doing it themselves, if they took their own money and they bought stock and the market was down, one of the first things that they're thinking of doing is, I need to be out. right? But then when they're working with a person like myself, we can have that conversation that, listen, we plan for this, right? And how we plan for this is typically through diversification. We're not putting all their eggs in one basket, right? We plan for this. If you need money right now, we have, your more safe investments over this side that you can make withdrawals from.
So you
Let's give the
separate it into different buckets then. So you have safe for short term, and then you have the long term where you can deal with the market downturns.
Right.
Okay,
So
I get you.
we're having that conversation and not just looking at, I want my money to grow. Yeah, of course, I want your money to grow. But we have to come up with a strategy that aligns with your goals.
So you're more
One
planning.
of the biggest goals that I work with my clients on is taxes, because I feel very strongly that taxes are going to go up. And that being said, majority of people's
When you say
money,
taxes,
right?
you mean everyday taxes or estate taxes or what?
We're referring to income taxes.
Oh, income taxes. Okay.
Yeah. So majority of folks' money, retirement money wise, are actually in 401ks, 403b, 457, the different kind of retirement accounts, which typically usually are taxable, right? They never paid any taxes on these accounts. So you look at your statement when you get it quarterly, and it's saying that you have 200,000, 300,000, 400,000, and that's great. But when you decide to start taking those withdrawals, that 400,000 that you saw in the balance turns into something else. No, I believe taxes are going to go up, right? So
why turn into something else? Explain that to me. You say turn into something else.
No, listen. You mean
you're going to get less because of the taxes?
Because you got to pay taxes.
Okay, I get you. Yeah.
Right. So if you separated from the job, and you see your statement, you have $400,000 in the account. You decide you're going to pull everything out to put into your savings account because you don't want to be in the market anymore. You don't want to see it drop. But if you pulled out that whole 400,000, now you owe taxes on 400,000 within 1 year. Right? You're in the top tax bracket. Right? The top tax bracket right now, I believe, is at 37%, or is it 39%? So you're
under that. It's 50-something% in Canada, but
but this is what I'm saying.
Go on.
This is what I'm saying. I expect taxes to go up.
Right. And is that per state, or is that the taxes? 37%?
Well, no, that's federal taxes.
Oh, federal taxes. You have state taxes attached to that, or
every state has their own taxes, and then in some instances you'll have local taxes, right? So you could have 400,000 in an account and end up not only getting half of it because of you not strategically withdrawing in certain instances when you should, right? Or because you, of course, didn't readjust your investments, do some reallocation to make sure you're not putting too much risk on the table. Because now, of course, all right, I'm gonna pull out 100,000, and then right before you pull out 100,000, the market was down 25%. You pull out $100,000, you're almost down to $200,000 because the market was down when you took a withdrawal. No, you need even more of a high return to get your balance back up.
Okay.
So all that we have to have a conversation with.
You help them with the strategic and tactical part of that to create tax efficient cash flow, more or less.
Yes.
Mm-hmm.
No, I'm having more and more conversations now, especially with my young young, not even just business owners, but my younger clients, and of course those clients that are in the middle of their career. They're having those conversations that, listen, you've been doing good, we may need to start looking at creating a tax-free bucket to offset potential tax consequences later on, right? And that's where the Roth IRA comes in terms of either you're starting one or potentially looking at some Roth conversions. And of course, not everybody qualify for contributing directly into a Roth IRA because it's all income based, right? If you're making too much money, the government doesn't want you to contribute to a Roth IRA because that money, all of it, no matter how much it has grown, is tax free when you're withdrawing it, right? So we start having that conversation more and more. Of course, even if you're older, right, you're on the brink of retirement, even if you're currently retired, you potentially still can do some conversions, but it has to be strategic. You can't pull the whole thing out with the intention of converting because you're going to owe taxes upon conversion. So we have to look for those opportunities to, do those conversions. It could be that you just decided to retire, right? You're probably, the income that you received in that year, or maybe you've gone to do some real estate investing and you could do some, there's some tax opportunities, some tax write-off that you could potentially get with that. There's so many opportunities, but you have to have that conversation with your clients, which, I try to do more oftentimes than none, to make sure that we can mitigate the potential losses that they can receive, not from market, but from taxes.
So
I think
one of the things
growing up,
that
they told me that there's two things that we're sure of: death
and
and
taxes.
taxes.
Yeah, I think, and one of the things that, and the importance of working, ask an advisor, as our name suggests, is that clients don't know what they don't know, right? And this is the importance in terms of what we bring to the table from that regards. But just want to step it back a bit. So you have a 30-year-old that walk into you that is, and I'm guessing you do something like this in terms of, okay, 30-year-old walk into you, don't have a company pension. You would help them to establish to say, okay, because you kind of spoke to this earlier on, but you will help them to say, okay, what age you want to retire at, how much you want to have as a retirement income. And then from there, you look at, okay, where can we invest based on your timeline? And, having that money, how can we grow that money to achieve the desired return based on how much you want to invest and how much you want during your retirement, and ensure that you have it coming out in a tax efficient manner. And then also, if everything works out well from an investment perspective, hearing you to say that we also look at the amount of money that will be left when the person pass away, and the taxes that would be there, and then we use that life insurance to pay that taxes, so that we're paying, as they say, pennies on the dollar from that regards. Would I be correct in summarizing it that way?
Yeah. So, younger, and I try to have this conversation too, even if you have something with the company, because here's what happens very often. You are working with your company offers not a pension, because you don't really have control over the income you're receiving from the pension. But companies more often right now offer a 401k plan, right? So they got away with the pension, and they're now offering you the opportunity to create your own retirement income through the 401k plan. So more often
Is that like a matching program for those of us who aren't in the US? You put in 3% and the employer match 3%?
Yes.
And then you, the worker, determine where it's invested, or the company determine where the money is invested?
You, the worker, typically will choose how you want your funds to be invested.
So even in that instance, they require some guidance, which I found out a lot of times they don't know what they're invested or how much that money will grow to be from that regards. Carry on, my brother.
Yeah. So even in those instances where they have something that they're creating, right, they don't have a strategic plan in terms of, I'm putting in $300 per paycheck, I'm putting in $500 per paycheck. Where exactly is this going to get me when I decide to retire, right? So the intention is just to put away something. They don't necessarily have a goal in mind. No, having that conversation.
And now have a false concept, if I may quickly jump in, they have a false concept that they have a pension.
Yeah. So and there are instances where I'll meet some folks and they've been contributing to their retirement plan and they have $100,000, for instance, in there, which of course is good money. But then the question then remains, if when were you planning on retiring? And quite often when I ask that question, they're like, I'd love to retire next year. So the question at that point is, okay, well, that's great, but where's that income going to come from?
Right.
So, not necessarily, because how we do planning as financial planners, as advisors, we need to see the finish line. What's the finish line? And then we start to work backwards to make sure that whatever you're doing now gets you to the finish line.
You start with the end in mind.
Right. Which is not necessarily something that they do when they're contributing to their employer-sponsored plan, right? They're just contributing into it because it's there and they want to create something. But then when we have the conversation, it's, all right, when exactly do you think you want to retire? How much income? I mean, because maybe you're going to need less money now than when you're retiring, which I don't necessarily know if I agree. I hear about all the studies that different companies have done and say that you spend less money when you retire than when you don't. I don't necessarily know if I agree with that 100% because I believe it's based on your lifestyle.
I agree with you with that, but not only that, people are living longer. You mentioned your grandmother, which is in long-term care, and we just mentioned that for some of the basic facility is $60,000 per year. So if you need more, then it's going to cost you more.
Right. So in that instance, I'm like, all right, so how much income do you think you're going to need to really, entertain the same lifestyle that you're living now, or based on what your goals are going to be? And they'll give me a number. And from there, I'm like, okay, so the amount of funds that you're going to need to facilitate this income. There are a few different strategies we can use. You can use the safe withdrawal rate, which is just, taking 4%, just 4% from your overall balance, right? So pretty much I'm telling them exactly how much their end balance need to be. And then we can look back on where they are now and see exactly if there's a shortfall based on where they are, what they're doing, if it will get them to where they need to be. No, if there's a gap, I'm like, all right, so based on where you are today, you're more than likely going to need to start contributing some more. Or we're going to need to reallocate your investments because you can't be sitting in conservative because you're afraid of the market earning 2-3% and contributing the amount you're contributing now, because that's not going to get you where you want to be, right? So because a lot of people are very afraid of the market, right? So they're saving, but they're afraid of the market and they expect to get to the finish line. It doesn't work. It doesn't work.
Yeah.
Right.
But I think part of it too, my brother, is that they haven't really seen the complete picture. So it's like, I put it this way, like you're doing a puzzle and you don't know what the puzzle is supposed to be. When you look on the box, now we have the picture on the box, we have an idea as to what the puzzle is supposed to be, where to put the corners and all of that. We're not sure in terms of, most clients aren't sure in terms of how this all work, because most clients are under the falls, well, not falls, but yeah, they have a pension at work, a retirement program at work that would be able to take care of them. But when you ask them, okay, how much is it going to give you when you retire? I don't know. Okay, where you invested? I don't know. I don't want to lose any money. So I'm saying, but I want to make money. Right. So, yeah, I want to make as much as I can, but I don't want to lose any money. I think from that perspective is because they don't understand how the market works. Because as you mentioned, when you look at the S&P, there were days that it was down. After 9/11 it went down. In COVID it went down, but then it came back up. Right.
Yep.
So you can see, I think there was a chart that's called a big picture where $1,000 was invested in 1934. And it grew to $22 million as at the end of 2025, but it didn't grow in a straight line, and that is where the explanation is needed. Warren Buffett said that he doesn't invest in stocks; he invests in companies, and I think a lot of times that clients need to realize that you need to buy companies, right? And you mentioned the S&P. So that will have companies like Walmart, Home Depot, Costco, some of the big name banks. These are companies that you're dealing with. Through this, you can own those companies. So when you're consuming Amazon, when you're buying from them, you're also profiting on the back end from that regards. My brother, I think we're over time a bit. The host haven't been hearing much from him, but I want us to just wrap up real quick by telling how someone can get in touch with you, what your digits are, what your contact information is, apart from in the Blue Blood Investment Group. How can people who are watching this video get in touch with you, your phone number, your email address, or IG, whatever you have that you can share?
Yeah, so I'm all over social media. So my Instagram is my first and last name, so Terrence Fenton, TERRENCEFENTON, right? Facebook is the same thing. I use the other ones, but not so much. My phone number, you can reach out to my cell, right? You could reach out 929-320-7100, or if you want to call my office, you could do that. So of course, I'm gonna get my cell, so that's fine. But you can also reach out to my office. Now you can go to my website at fentonfinancialny.com. So that's Fenton Financial, no S, NY as in New York.com. Right, you could go there. You could scroll my website. There's a bit of information there in terms of me and pretty much just about how I do my practice. My practice usually is more about financial planning overall, just looking at the bigger picture, and then just honing in on the different pieces to make sure that we put the puzzle all together, right? So of course, we don't necessarily have to do financial planning, right? If you feel like it's more complicated, if you want to deal with individual products, whether it's just the life insurance or you have an old 401k that's sitting around, you want to earn some money and you want to make sure it's protected, we have strategies to facilitate that. So we can work on the smaller pieces. We can look at the whole big picture to make sure that everything is aligned. Just reach out to me directly to my cell. Connect with me on social media. I post all the time. Sometimes I think I did a very funny video today, me trying to dance. But I'm all over social media, and I always pick up my phone. If I don't pick up my phone, I'm gonna call you back.
Another thing, just real quick to wrap up, is there a cost for your service, and can you deal with? So let's say we have someone in Florida. Can you deal with that person from? What if they're in Jamaica? Can you deal with them too? Just to put that on the table.
So any one of the 50 states I can work with you. Of course, depending on the kind of business you do, again, it's just really paperwork to make sure that I'm licensed to work with you depending on what you're doing. Insurance business, there are different licenses for each state. Investment business, it's just paperwork, really. Of course, it's more paperwork for the insurance piece than others, but that's fine. Like if you need to get something done, me getting the paperwork sorted out for me to work with you, that's nothing.
That's not a problem.
In terms of cost, it depends. So what I've been doing, because I realized so much that financial planning is very important, but I understand that not everybody realize how important financial planning is. I've actually been waiving my financial planning fee just to give you an overall picture as to what is needed, right? In terms of everything else. If it's investment business, right, I do fee-based investment management. However, if you're not necessarily if you don't feel like you want to pay a fee to have your money managed, that's okay. We can find a program that doesn't charge you a fee. But I mean, if we go into the weeds, if you're doing mutual funds, if you're even buying investments, there are typically broker fees. There are expense ratios within mutual funds. So you're paying it whether they're telling you or not. There's something that you're paying, right? I think it's less expensive if you actually pay an advisor to manage your money, but that's besides the point. We can find a way to accomplish any goal that you're looking for. Again, if you're looking at the investments, that's fine. from the life insurance side, the company typically pays me to bring them the business. So you're not paying me extra to do the life insurance. You're just paying your premiums to make sure that you're getting the service you need. Whether that's to cover your family, to make sure that your family's okay if you're gone, right? And I know this may be funny for some people, but I've met people who have said, you know what, I don't want to leave any money behind, and if something happens to me, my wife's gonna run off with some other dude. Well, guess what? If you don't leave her with any money, don't you think she's gonna need to go find another dude, right? So
Or
make
vice
sure you
versa.
leave her
Or
with
vice
the money.
versa.
Make sure you don't leave her so she
Equal
doesn't
rights.
have to go
Equal
find
rights.
somebody
Equal
else,
rights.
right? So yeah, regardless as to what kind of needs you have, as long as it's with regards to finances, I can help, right? One of the things that I didn't mention is that I'm ultimately branching out my practice to Medicare insurance, which is for folks that have gotten to 65. So that's health insurance for folks that have gotten to 65. Or if you're disabled before 65, you ultimately may qualify for Medicare. So I'm branching my practice into that. And then I'm going to start to go into some other things. But whatever it is, when it comes
So
to
on that
finances,
note,
feel free to
what is
reach
it
out.
that you cover? On that note, what is it that you cover in your practice? Just to close it off.
For Medicare?
No, just your total. You mentioned insurance before, long-term care, and investments. You mentioned Medicare. Is there anything else that you cover that you wanted to highlight that you think is important to highlight? And
I'm
tax planning.
I'm about to expand into property and casualty. That's car insurance, property insurance, commercial insurance. I'm about to expand my practice into that. I haven't gone to the extent to do that yet, but I want to make sure that my clients know that there's absolutely nothing that I will not do to make sure that their needs are taken care of. Even though I may not offer something currently, I do partner with other people, but I want to make sure that they know that they can reach out to me for anything, right?
Full service brokerage from that
Yep.
side, if I
Yep.
can put it that way. And just to close off, just remind of the website and your phone number that they can contact you, and possibly email address.
I can put
Yep.
those
So
things in the description, by the way, guys.
yeah. So
Okay.
so cell 929-320-7100, and my website is fentonfinancialny.com.
All right.
You'll see it in the description. Look down in the description below. Of course, Roger's
All
gonna
right.
take care of that. But
Thank you very much,
Hey,
Roger.
the only thing I wanted to ask, by the way, was
Uh-huh.
it had to do with young people. You know, what is the age? Is it 30? Is it 35? Is it 25? When do young people need to start looking about insurance? Because, you know, it's probably an older person's thing, but young people would, you know, youngsters don't even know they're supposed to participate in their 401k. They don't see the need. They don't know. No one's told them. You know what I mean? So what age do you think?
Insurance and investments. You mentioned 401k.
Correct.
so let me touch on this, and I'm gonna use a very very famous family with regards to this, the Rockefellers, right? Now, if you're looking at real legacy planning, getting the insurance even from when you're a baby can be helpful because it's going to be dirt cheap, right? And especially if it's a permanent life insurance policy. Of course, insurance companies don't sell term insurance to kids. Permanent life insurance policy on a baby, it's going to be dirt. I don't really like to say cheap, inexpensive. It's going to create cash value, and ultimately, especially if it's a larger death benefit, it can really create wealth. And guess what? If you're a parent or a grandparent and you're purchasing a policy on your grandchild, for instance, you ultimately can be creating a legacy not only for your grandchild, who ultimately will have access to that cash value, but if eventually when they pass away, they can essentially leave a legacy through you. So you created a significant amount of death benefit by purchasing a life insurance policy on that grandchild. They have access to the cash value that they can use while they're alive, whether pay for their first car, pay for the college, pay for their first home, and still leave a death benefit to their children. So I don't think there's a specific age to which you really should buy insurance. I think it's a matter of what exactly your goals are, right? I say get it when at your youngest stage. But if you have specific goals, covering a mortgage, you have legacy that you want to leave. At the moment you find that you have these goals that you want to achieve, get the policy.
You're saying so somebody like me who is not Rockefeller like Roger, but more humble from humble beginnings and all of that. You're saying that like when I got married, or if I probably have a child, then I should get that life insurance. Make sure I have that life insurance right away, or I
Yes.
buy a house right away from those or some what do you call it, life stages that would necessitate me having insurance. What
Yep.
about from the investment side of it? When should we start thinking about investments and retirement and all of that as a young person?
I mean, the younger you are, the earlier you should start. I mean, I think I looked at a case study for someone that started investing. I think it was at 18, putting away about, I think it was like, I don't remember the numbers, but let's say they started putting away $500 a month, which is $6,000 a year, and they did that for, I think, 20 years. So they started at 18, stopped at 38, right? They didn't put another dollar in, right? And they were able to hit $1 million at, I think it was either 50 or 60, whereas someone else who started like 10 years later contributed even more and still had difficulty, even though they were getting the same returns, still had difficulty catching up to that person who ultimately started earlier. So starting early to invest can be very, very, very important. Again, it's the power of compound interest. The longer your money gets to compound over time, if you look at the rule of 72 for the folks that are looking out there, if you want to know how quickly your money will double, use the rule of 72. Divide the interest rate that you're looking at. So 72 divided by the interest rate that you're looking at returning, and that will tell you the amount of years your money will take to double. So for instance, 72 divided by 7, your money would double in around about 10 years, right? So again, if you are getting lower returns, it's going to take longer to double. So you want to try to get a little bit more aggressive, especially if you're younger, right? When you're older, you have to dial it back. So you get what I'm saying? You really want to make sure that you start young, start putting that money away, even if you're looking at $50 per paycheck, right? When you're younger, because I know when you're young, the income is not all that great. $50 a paycheck when you're young, and you don't necessarily have to be too crazy about any specific stocks. You could buy an S&P 500 index fund.
So on that note, in terms of the S&P 500, for the past 5 years, it has been doing approximately 14.8% annualized average of 14.8% per year, and 13%, 13 point something percent for the past 10 years. You mentioned the rule of 72. If you're earning 14.77%, your money will double in 5 years. And I just wanted to piggyback on your $1 million. If you have $1 million, that $1 million can generate an income of approximately $5,000 per month. And assuming you're earning 8%, and still after 30 years, you still have $500,000 remaining, right? So you can, if you have $1 million and you save up to, you have $1 million, you can potentially retire on that $1 million, earning an income of approximately $5,000 per month. My brother, we've gone over time for about 15 minutes, but I love the conversation, and I love the fact that you've been able to highlight what you're doing and how you're able to help and share the knowledge. This is the first in our series of Acts and Advisors. Acts and Advisor, we hope to have others where we bring different advisors from different areas to cover what the services that they offered in their locale, Terrence, I want to thank you very much for being our guinea pig on this, and for the information that you've shared, and looking forward to having more sessions with you. We can be more specific later on in terms of how you set up different things, whether it's a insurance policy or an investment policy. We can just dedicate that time to do a specific material and do a deeper dive, because I think that's going to be necessary later on. Roger, I don't know if you have anything that you want to say just to close off.
No, I just want to thank you guys for your time. This was really, really good, very, very good for me, and I just hope we kick off something with this. So this was really good. Thank you, guys, very much.
All right, thank you, and we look forward to seeing you. We're hoping that we can bring this to you at least once a week. That might be a bit demanding, but at least once per month, if we can put it that way. So we're, as Roger would say, like and subscribe. And if there are anything specific that you want to have covered, please don't hesitate to let us know. Thank you very much again for Roger for facilitating this.
No worries. Any questions, put in the comments. Thank you, guys.
All right. All the best.